on this slide we discuss situations where income was taxed in the trust and then paid out in a later year. So it's best to probably just illustrate it. Right, here's a trust. This trust owns a block of flats. It's one of my favorite examples, as you've probably noticed, that earns rental income. Right. This rental income, again guys, doesn't matter, it can be dividends, whatever it is. This rental income, the trust deed says there's no one with a vested right. So if there's no one with a vested right, what does that mean? It means that trustees must make a decision, use their discretion, so discretionary payments, to pay out the amounts to beneficiaries. Now, let's say in year 1, there was 100,000 rands rental earned. And it was not paid out. And I'm just going to write for now that there's no donor. Right. When there's a donor, it might complicate the situation a little bit with section 7.5, but I don't want us to consider any of those things now. That's why I'm saying there's no donor. This is a concept what I want you to understand. Now, this rental income, year 1, the trust earned 100,000 rands and it was not paid out. Year 2, it earns 150,000 rands rental income, and plus it is paid out to a beneficiary. Right, and the total amount that's paid out to the beneficiary is 250,000 rands, which is the 100,000 rands in year 1 and the 150,000 rands in year 2. What I want you to see is that this 100,000 rands in year 1, that 100,000 rands was taxed in year 1. I want you to understand that even though it's paid out in year 2 to a person, in year 1 we would have finished all of the tax consequences around that, and it would have probably been taxed in the trust in year 1 in this situation. But what I want you to see is it was taxed in year 1, thus cannot be taxed in year 2. This amount is what we call capital of the trust, and it's not capital as in contributed tax capital, or as in capital as in your stated capital and your equity and things like that. It is equity, but it's retained earnings. It is what people would refer to as the capital of a company, for example, right? So it's more of the common tongue, if you have to say it like that. So capital, right? So not capital as in selling your capital asset. It's the capital of the trust. It's retained earnings. So what I'm saying here, what the principle here is that something was earned in year 1, was taxed and everything in year 2 and year 1. In year 2, if it's paid out, there are no tax consequences for the person receiving it. Right. So it will be tax-free. Make sure that you see there, tax-free. And that's because it has already been taxed. Okay, so guys, what sections are we going to see in trust questions? What sections do we see? What are important? There are 3 big sections. There's section 25B, capital B, section 7, and then paragraphs 68 to 73 and paragraph 80 of the H schedule. So the H schedule, guys, that deals with capital gains, obviously. Okay, now, what I want you to see about these sections, and this is the first place where students go wrong, is students think that all 3 of these sections relate to trusts, and they don't. There's only one section that relates to trusts, and that is section 25, capital B. So this is the only section that relates to trust, and that is why it is one of the most important sections that you'll see. The other 2 sections are most often asked with trust questions, but they are not related to trusts. They are related to donations, if there was a person that made a donation. And that is why you'll see when we look at trust, it's very, very important to always consider if there's a donation. So if there was no donation, then there's no section 7 and no paragraph 68 to 73 at all, which you have to consider. And that is very important. So make sure, did you listen to what I'm saying there again? If there is no donation, you do not look at section 7 and you do not look at paragraphs 68 to 73. So when we look at all of these weird little sections, distributions to minor children, all those type of things, please remember that is in section 7 and paragraph 68 to 73, and that has only has to do with donations. So this is the approach that we will follow, and this is the most important slide for me up to this point in time that you've seen in trusts. This is the whole, when I talk about the approach it will follow, this is the approach. Now guys, this is how the approach will follow. We're going to start here. And you'll hear when I'm going through some, if you work with questions, you do lecture examples, you'll hear me the whole time I'm going to say the following to you. I'm going to say, was there a donation and is the donor alive? So see, there's two questions I'm asking. Was there a donation and is the donor alive when the income was earned? So the donor must have been alive during the year. It doesn't have to be alive for the entire year. It must have been alive for some part of the year. When we talk about a donation, please note that it is either a full donation or something like a low interest loan. Those are considered donations for this section. Right, so that's the question, first question we ask. Was there a donation and is the donor still alive, or was the donor alive? If you say no, then we look at section 25B1 and section 25B2. So section 25B. Section 25B, to remind you, is the section that relates to trusts. So, see now what we ask. So we say, was there a donation and is the donor alive? No. Then we say, does any beneficiary have a vested right? Or did the trustees pay out an amount to the beneficiary? So what I want you to see is, here's the trust. And there's two amounts. There's an amount paid out to A and there's an amount paid out to B. Let's say 100,000 rands. And B, 50,000 rands. 100,000 rands, A has a vested right to it and B has a discretionary right to it. So discretionary means he doesn't have a vested right to it, so he's not entitled to it, but the trustees made a decision to pay it out to him. Remember, at the moment they pay it out to you, right, it's almost treated as a vested right. So what I wanted you to see is, does someone have a vested right? Yes. Or did the trustees use the discretion to pay out the amount? Yes. So who will be taxed? If you say yes, so like we said in this case, yes, who will be taxed on the 100,000 rands? A will. Who will be taxed on the 50,000? B will. So the people who received it. If the amount was not paid out, so if this trust had 150,000 rands, here's A, here's B. A has 100,000 rands, which has a vested right, and B has a discretionary right, but he received nothing during the year. The trustees decided not to pay out. The 100,000 rands vested right will be taxed in the hands of A. The 50,000 rands, remember, there's 150,000 rands that the trust received, 100,000 was paid out to A. The 50,000 rands that was not paid out, so this 50,000 rands over here was retained in the trust, so it was not paid out. That 50,000 rands will then be taxed in the hands of the trust. So, this is the question we ask. Was there a donation? Is the donor alive? No. Who has a vested right or who received the payment? That is the person who will be taxed. If it was not paid out, then the trust is taxed. Okay. Now, look, next one. Was there a donation? Is the donor alive? Yes. Then we will look at section 7. We will also look for CGT at paragraph 68 to 73. It's the same idea here, the concept. So was there a donation? Yes. We will consider these special sections. And if those special sections apply, the donor is taxed. If the special sections do not apply, then we will go back to section 25B. We'll ask the same question. Does someone have a vested right? Was it paid out? And that person is taxed. If it was not paid out, then the trust is taxed if none of the section 7s apply. Very, very important that you see that.